Couple of hypotheses here, or stock picks, and I guess my question is on the buys, is it a direct derivative of what you think the Fed is going to do, and are your sells because of what the Fed is likely to do?
So, Tyler, a combination of both, actually. So let's break it down. On the buys, these are companies that are cheap. JP Morgan trading at 14 times earnings, Chevron trading at 13 times earnings. Both have solid balance sheets. Let's take Chevron, for example, almost a 5% dividend yield. And when you get into an area when the Fed is going to taper and then potentially tighten, you want companies that have immediate cash flow. You have companies that have solid balance sheets, and you have companies that can actually grow their market share. So in the case of Chevron, if you do have some break in the market, they have enough capital. They're going to have $25 billion of free cash flow in the next 5 years to either buy back shares or buy competitors. In the case of JP Morgan, what the Fed is doing by taper is saying, look, our economy is pretty strong. We don't need to give free money out there. Well, JP Morgan makes money when the economy is strong, when lending comes back up, when M&A activity comes back up, and when asset management picks up, and potentially when interest rates move. So a combination of companies that are trading at 2/3 the market valuation with strong dividends that are growing. Take the other side of it. When the Fed is saying we're going to taper and the economy is strong, well, what they're saying is we want to be in companies that can really grow and where cash flows, again, are coming in now, not in the future. And the companies that I would sell at this point did very well when we had a lot of uncertainty, but the competition has actually come back to them. So take Teladoc, for example. It's a very good company, but it trades at a multiple of sales, and they're not cash flow positive. The acquisition that they made last year is worth more than the combined market value of the two companies. And more so, Tyler, their competition is there. United Healthcare is now competing directly with them. So what is the moat around their business, especially when investors are going to be looking for cash flows up front?
You could certainly say the same thing about your second sell, which is the much beleaguered Peloton. They've got they had a sort of first mover advantage here, but nobody's standing still. Right. Well, I guess that's sort of a funny way to put it, isn't it, for Peloton? But nobody's standing still.
Exactly. And if you look at, okay, valuation matters. And what is Peloton saying? Our cash flows will be much greater in the future. Well, you get that discounted back in today's dollars, it's worth a lot less. More so, like you said, nobody is staying at the same place. The moat around their business is disappearing. Two things are happening. You've got some more competitors in that space, and you talk about the Apples of the world and Fitbits of the world and everybody else. And then the other part that I think people have to understand is that we are reopening. And this was a great story when we were all stuck at home. And in a hybrid world and a reopening world, this stock needs to really reflect earnings growth, not just revenue growth in a company that people are going to be focused on rejiggering their portfolio to, hey, I want companies in today's dollars.